Good afternoon, everyone, and welcome to Stock Market Today. It's Coram and Ed Carson here with a look at how the week unfolded. And Ed, what a wild week it was.
Yeah, absolutely, Ali. Pretty exhausting week once again. Going to take a look at three stocks that are not in position but are growth names that investors should still be paying attention to: Shockwave Medical, Aehr Test Systems, and Digi International.
All right, we will get to those, but first let's look at the major indexes to cap off the week. Some relatively large losses for the major indexes. The Nasdaq down almost 3.1%, so taking the hardest hit today. We also had the S&P 500 down 2.4%, the Russell down 2.3%, the Dow off by 1.3% today, and this comes on the heels of very stunning upside reversal on Thursday at huge gaps down in the morning on that CPI number, followed by a big rally. But we're back to where we were essentially at Wednesday's close here for the NASDAQ.
Yeah, I mean, it was unclear. It's always a bottom has to start somewhere, but we don't know if Thursday was a bottom, and this was not an encouraging day. The Nasdaq, offset, lost more than it gained on Thursday. Obviously, still above Thursday's lows. S&P probably wiped out about that, as you say. The Nasdaq is the big laggard in the loss, and also all it did was hit resistance at the 10-day line, which is just the barely, it's almost like somebody putting an imaginary line. Don't cross it. And it's like, ooh, and the Nasdaq wouldn't cross it. The S&P and Dow, they hit resistance around the 21-day line. The S&P didn't quite get there and fell back. The Dow actually had been above it and came down. It did a little better because there were some earnings today that helped keep it up. But we're hitting resistance. We rally one day, we rise one day. A rally attempt has started, but we immediately fall back, give up a lot or all of the gains from the prior session. We're right at bear market lows. I mean, you've drawn that 21-day line basically sort of coincides with sort of a channel that you can draw. We're still below that level. We're still in this downtrend. I mean, it's just like wavering around. Like if you waver back and forth, but you're still heading one direction, you're still headed in that direction. And that's where we are right now. Until that's broken, investors should probably think, we're in a bear market. Investors should behave that way.
Mm-hmm. And it would be the primary expectation after you see a strong upside reversal in some volume, arguably not the heaviest volume. It was, slightly heavier, but maybe not like astoundingly heavier. But one would expect that strength to continue. So the fact that we did not see a continuation of that strength does say something like you said, we're still above the lows from tomorrow. So in a new rally attempt, but let's also give our audience perspective of the weekly action here. So, end of Thursday, we did see this bar turning blue, but now finishing the week back in the red. Intra week, we got to our lowest levels since early July 2020, Ed, almost down to 10,000 for the NASDAQ. So this third leg down definitely feels more like a leg down at this point after this week.
Yeah, the leg down, sort of getting that whole leg. The prior couple of weeks, we were sort of like putting our toes below, and now we're really getting below there. The 10,000 level, there's also the pre-COVID high of 9,800. So we're right around there. You can argue that this is around the area where we could find support. Doesn't have to find support, but you can make an argument there. The S&P is doing something similar, where it's slightly above, the pre-COVID highs. The Dow and the Russell have actually gotten back to their pre-COVID highs, and they did a little better this week. The Dow actually rose for the week, not much. I mean, but so it did get there. Doesn't, so it's just something to look at. But yeah, we've come down a long way. I mean, basically, we've been certainly on the NASDAQ, we've been in a bear market just in the last couple of months. And obviously, this bear market has been going almost a year. So we'll just have to see how much further it goes.
That we will. All right. And next, let's also check in on the 10-year Treasury yield. And it looks like we're back above that 4% 5% level, which we hit intraday on Thursday, saw it back off a little bit, but now back above that level. So that would be passing the high that we saw on the 27th of September. That's getting pretty far up there, Ed.
Yeah, it's pretty far up there. We're at a 13-year high. I believe this is 11 straight weeks that we've been rising. So really just unrelenting. It's just hard to see the stock market having a sustained rally. Yeah, we rebounded powerfully yesterday when the yield rose, though the yield came well off its high. But it's just really hard to see that happening if it's trending up like that. And that's what it's doing. And while the 10-year yield has been rising, the 2-year yield, which, that one's up at 4.5%. That one showed even it's just been really pushing higher. So that's just a lot of issues there. The inflation report is really negative. I mean, we came into it, we need inflation to cool down. We need the yield to probably cool off, and we need Fed expectations to cool off. Well, what happened? We got inflation that was hotter. We got yields that were higher. Fed rate expectations higher. So everything that you sort of need.
And consumer confidence still strong. Jobs report also strong, right?
Yeah, so there was all sorts of things. I mean, there were some positives. So the earnings we got, which weren't that many, but there were some big names, and they were generally positive. We got some positive news out of the UK after that had been sort of disruptive. But, those are just sort of little things. It's ultimately the Fed, it's ultimately the economy, and that's really just not that's not suggestive of a strong market rally.
Well, definitely some very good context to have. And just a quick little plug coming up at 5 p.m. Eastern. I'm going to speak with Dan Fitzpatrick of StockMarketMentor.com to pick his brain about his price target for the S&P 500. He's saying we still got a lot more pain ahead. And he calls this bear market, it's a teddy bear market right now. So, maybe to see really the roaring crazy bear. Maybe there's
it's going to get grisly. He's going to get grisly. He says,
we're not at the grizzly level. We're still at the teddy bear level. So we'll talk more about that live on YouTube at 5 p.m. Eastern. But I digress. Ed, let's talk about some sector action this week. Here's XLE off about 3.7% on Friday. For the week, still down about 1.8% after a strong week the previous week. So still holding up, but coming in a little bit this week. What do you think?
Coming in a little bit. I mean, energy prices came down more than XLE did. So that was pretty good. And you could argue that they sort of needed a pause after that big surge. So this is somewhat constructive, but obviously, like everything else, it's going to be very tied to what oil and natural gas prices do, and that's always it's tough to know with so many factors going on.
All right. Well, what about healthcare? Here's XLV up for the week. It's been a kind of an underperformer versus some of the other sectors we've seen, but 1% gain this week.
Yeah, and you can see while it's an underperformer, look at that relative strength line. It's actually moved back to a high. It's just like not plunging in the last few weeks has really helped. It is interesting because this one seems to be the safest sector, but it's really only some stocks. I mean, there's some biotechs, there's some drug makers, there's some health insurers. Those are doing well, but you can't just say, oh, any health stock is doing great. And that I was actually surprised at how weak this was overall.
But you're right. If you find the gems in the group, there are some standouts. Let's also talk about chip stocks. That is an ugly looking chart. Here's SMH down over 8% this week. So really taking a hard hit here, Ed.
Yeah, I mean, there's been a lot of warnings. Wouldn't be surprised if we get some more. Taiwan Semi was pretty good this week, but we also have China. There's also been some pretty significant export curbs, and even like employees or U.S. employees, I think, are going to have to choose between Chinese U.S. citizenship or having jobs in China. So, I mean, there's a real wrenching stuff going on in the chip industry on that front. So it's going to be difficult to do. And if chips aren't participating, that's a bad sign for the market as well. Huge share of the market, and they're in everything. I mean, they're in everything. So if chips demand is bad, that's bad for all these other products.
Yeah, not good to see. Let's also take a look at the more speculative growth area of the market. ARKK here, Ed. Look at this finish this week, the lowest close in quite a long time. I know we've gotten some closes that are basically right around maybe a little bit below that close of the ugliest COVID week for ARK, but now I mean we're testing that ultimate low, almost undercutting the COVID lows at this point for ARK. So for those who maybe thought that the bottom was put in over the summer, not so fast.
Yeah, and that could be a little reminder for the market in general. It's like, oh, just because we go to the pre-COVID highs doesn't mean we can't go to the COVID lows. Yeah, really weak. This didn't, some of the speculative growth names just didn't do well even on Thursday. Even on Thursday when everything else was ramping up, wasn't that good. And this is a 5-year base. This would be a 5-year low if it gets below there. It's there's just so much damage, and it's just been going on for a while. Obviously, so much damage in so many places. So it's you think that things are going to bounce back, and then, and as you say, then you can always go lower.
Yeah. Yeah. All right. Well, that's not looking good. But let's take a look at some growth stocks to see how they're faring in this market. And our Shockwave we've been talking about in recent months as a potential new growth leader. For especially once we get on the other side of this bear market. But it's definitely not immune to taking hard hits. Down over 7% today. It's still holding within a base here, so that's good, Ed. It's not buyable at this time, but at least for now, it appears to be still watch list worthy.
It's watch list worthy, and we'll see. It can't really take much more damage before it starts really starting to break down, and that clearly could happen. I want to make that absolutely clear. And if the market keeps going down, I mean, part of the issue with leading stocks is that they tend to move more than the market. Well, if the market's moving down, it can get bad. And so hitting resistance at the 50-day line, a trend line, if you want to draw there, you could draw it differently. But however you do it, it's like hit resistance here. If it, in theory, if it moved, if the rally picked up some strength, this stock is, the RS line is at a high. The growth is tremendous. You could imagine this one taking off and having really big gains. Without that too much, but it definitely needs to hold support soon, or it'd be giving up all of that earnings gap. That's in danger. That really triggered a lot of this move. Definitely when watching, because look at the fundamentals: triple-digit revenue growth. It's turning profitable, so there's these massive earnings gains. Next year is pretty strong with the estimates rising, so a lot to like. But yeah, this definitely can see. It looks strong, goes fine, and then you can have these pile drivers, because if you bought at the high today, it was probably about a 10% loss, and you just don't want to be doing that right now.
I mean, right now the depth of this base is 22%. There is one scenario. What if it turns into a double bottom base that has corrected 35%? I mean, maybe that could happen. But for now, we'll have to see if it can hold above this low from late September. Still looking pretty strong, but we need that market to cooperate. Let's also take a look at AEHR. So speaking of semiconductor stocks, this one looking a little different, a turnaround with some pretty big buying here coming in over the summer, now working on a base. A trend line sort of around here, maybe that you could draw as well, with the stock hanging around that 50-day line and the 15 level. What do you think about this for the watch list, Ed?
Once again, as well, I mean, last week it blasted higher on blowout earnings, and you probably could have drawn a tighter trend line at the time, and it was breaking six. Look, see, and it was moving really well, powerful volume, especially on that day. But it's basically given most of that up. Certainly from the gap up, anybody who sort of bought on that gap up was hit. You can see how it fell like 10% today, 14% for the week. So again, the prospects, I mean, if you look longer term, you step back, and if you're not involved, it's like, hey, strong growth. It's holding in a base. The relative strength line is pretty high. you can, it makes these big moves. And so if we get into an uptrend, then you can start seeing, well, wow, I'd love to see the 10, 20% gains in a week. But right now you can easily see 14% drops in a week, or up 20% in a week, down 14%, and you buy near the high and then get hit. So a lot to like, and even the PE isn't that high, whereas Shockwave was pretty high. This is not that high. So there's a lot of things why people should be looking at this, but it could easily, this was a bad day, has another day or week like this, and it could be breaking below the base, just like Shockwave.
Exactly. And I think, new buys are clearly, by and large, there are some things that are working, but by and large, still pretty treacherous right now. So even for strong stocks. So it seems like, Ed, if you're going to take a stab, go in pretty small and have a clear exit strategy, because there's a lot of stocks, even the strong ones, that are not working all too well right now.
Yeah, 100%. And with these names, again, just to stress again, I think if the market turns, and not just one day, but if the market turns and really picks momentum, this is why we talk about an uptrend. If the market's generally going higher, a lot of these names are going to start looking, much more consistent, much safer and much stronger.
So we'll cross our fingers for that to happen sooner than later. You never know. We'll be ready. Could have a lot more downside to go, but we could also see, at the very least, some tradable rallies, which you and I talked about on Barron's Live today. So we encourage everybody to check that out. We'll get the archive out on YouTube later today. But here's a look at DGII to round things out in the computer networking group, which, by the way, ranked 14 out of 197. Similar story here, Ed, in that it had a pretty decent week last week, but down almost 12% now this week.
Yeah, I mean, it hit a record high as recently as October 6th. So just last Thursday, it was there. I suppose this is one that you would have argued it was very a messy pattern, so it would have been hard to really find a buy point. But if somebody did, this is why you'd want to treat it as a swing trade, like a really short-term situation. It's the RS line has come down, sure, some, but that's after a long run. On Thursday, market rebounds. This stock really fell sharply, basically almost undercutting recent lows, didn't quite, and then closed flat essentially. But then today came right back down. So again, now you can just show how much even these leading stocks are so influenced by the market. It's not broken. It really does need to form a base, where some of these others you could imagine, it wouldn't take that much for some to set up. This one seems like it needs just more time. It isn't like a broken stock, but it doesn't really have a clear entry right now. But definitely with the growth it has and solid growth next year, and a solid group, there's accelerating growth. There's a lot of reasons to want to keep an eye on this one.
Right. All right, Ed. So while days like Thursday could be pretty exciting, what should investors be doing right now to prepare for the week ahead?
You need to be patient, for one, is just not be doing much. It's probably in terms of actually trading for the most part, unless you really are suited for a day swing trade type of mentality, really, and then preparing or prepping. I mean, getting ready for that next uptrend. And, you can look at stocks like this, or maybe stocks that aren't quite as volatile, that are holding up even a little better, like a Vertex or a Chevron or some other names out there. But, just getting ready, looking for stocks that have strong relative strength, that have decent or excellent fundamentals. So you're ready
in uptrends.
In uptrends, if possible, hopefully in general uptrends, and looking for things that are working. But it's just waiting for that, because you don't know. We may have an uptrend. We could have a follow through day next week. Could be next month. May not be till next year till we have a real sustained rally. So it may be some time before that happens. But you just want to be ready, because that's when the money is to be made, rather than trying to jump in front of a very fast-moving steamroller.
Exactly. Yeah, what Mark Minervini calls a hard penny market. When it's so hard to even just try to make a penny. It seems like by and large the feedback that investors have been getting in this market. So stay safe out there and keep those watch lists fresh. and be fresh yourself, right? Mentally ready.
Yeah, that's a good enough reason there just to stay out. Honestly, it's like your capital,
Yeah.
preserve your capital, and to stay mentally fresh. You don't want to be exhaust yourself in a bear market, and then not really be ready for when the market turns.
Great point to end on there, Ed. Thank you for that. And thanks everyone for watching. Once again, you can catch me at 5 p.m. Eastern with Dan Fitzpatrick live on my YouTube channel and on Twitter. I'm at Alyssa Coram, and on Twitter and at YouTube, youtube.com/Alyssa Coram IBD. So catch you there, and we hope you have a great weekend. We'll see you back on Monday morning on IBD Live, investors.com/IBD Live for all the details on that. We'll see you then, everyone. Have a great weekend.